To order. Sorry, we're running late. Part of it's my technical issues, but anyway, we're going. First thing we need, Judy, is roll call.
Ms. Covison is absent. Mr. Hawkins also absent. Ms. Cavanis?
Here.
Mr. Jurdy?
Here.
Ms. Smith?
Here.
Mr. Cromer?
Here.
Mr. Shoemaker is absent. Ms. Harris? Here. And Mr. Anderson?
Here.
Thank you.
So Jim will be a voting member. Well, Richard is out, correct?
Correct.
Okay, good. Okay, we do want to do the Pledge of Allegiance. I don't know if there's a flag anywhere, but we can pretend. And will you all join me? I pledge allegiance
to the flag of the United States of America and to the republic
For which it stands, one nation, under God, indivisible, with liberty and justice for all.
Thank you. So our first item of business is to take public comment on any of the items that are not on the agenda, on any topics related to the board.
There's no public in attendance at this time.
Except for me. I'm on your public list.
Oh,
No, we moved you to panelist.
Oh, okay, good, good. So okay, thank you. So our first agenda item is a resolution authorizing our teleconference meetings. Hopefully we pass it. So
I'll move to approve.
okay, Dan moves. Any second?
Second.
Any
Ms. Harris,
further
second.
discussion? And we'll need a roll call vote on that.
Ms. Cavanis?
Aye.
Mr. Jurdy?
Yes.
Ms. Smith?
Aye.
Mr. Cromer?
Aye.
Ms. Harris?
Aye.
Mr. Anderson? Oh, you have to step out. Okay, sorry.
That's right, we still have a
He's
quorum.
absent. Okay, approved. Thank you.
Okay, Dan, you're gonna have to get on the I group here.
Slowly wearing them all down.
Yeah, we are.
You are. Our next item of business is our consent agenda. We have the minutes of the July board meeting, the July retirement report, and the preliminary monthly financial report. Do I have a motion to, I guess we don't have to move on that one. Do I have any public comment or any items that directors would like to take off? Seeing none, I will say that we approve the consent calendar unanimously. And we will not then have item number 3 on the agenda. And we will go forward to item number 4, which is discussion regarding the historical benefit review project status report and project updates. So Director Rentschler.
Thank you, Chair Smith. There is a memo in your board packets this month regarding the project report. It indicates that there is no activity to report for the past month. However, it does give you a current summary. There are 232 accounts still requiring correction. Approximately 100 plus have a purchase issue and will not be fully resolved until we get a compliance statement agreeing to the correction methodology from the Internal Revenue Service. Progress on the project was slow due to the fact that we dealt with the recruitment of the 2 retirement specialist positions twice, actually. Both positions are filled, and Nora and Judy have been training our new retirement specialists, Maddie and Lauren. So we're glad to have those ladies on board. If you have any questions regarding the project or the report, I'm happy to answer any questions.
I will ask Doris, I think you asked in your memo if we wanted to continue this as a standing item or just bring it forward when there have been updates.
Correct. I did want to know that. I expect that over the next few months, progress will continue to be relatively low. I could bring it back quarterly. I could bring it back monthly if there was activity, or do you want to just leave it on the agenda every month and have me report even when there's no activity, that there was no activity?
Trustees, do you have a thought on that?
Madam Chair,
I hear somebody. Yes.
it's Jerry. I would like to see it come up monthly.
Okay.
So that, our constituents, our members realize that we're looking at it, we're always trying to move it forward. That's a personal statement.
How about the long spreadsheet with all of the errors and all of that? How often do you want to see that?
That would be the report that I would bring back unless there's different direction from the board. I didn't print it this month because there were really no changes other than to add that we didn't process any during last month.
Okay. Everybody else okay with Jerry's comment? Richard, yes. Okay. Good to see you, Richard.
So actually, I'll bring back that long report when we have corrections that are newly added to the report so you can see them. If there's a month like last month or this month when there wasn't actually any corrections processed, I'll just give a verbal update. Would that be acceptable?
Yes.
Super.
Right. Thank you.
Thank you. It is interesting to be chairing the meeting from the Zoom perspective, because I can see, Doris, when you're talking and you're looking at me, I just see your profile because you're looking over there. And so that's the way I am when I'm chairing the meeting and I'm looking at somebody who's on Zoom, you know. It's interesting. Anyway, okay. Well, at least there's not an empty room for Greg and Callan. So we will move on to item number 5, discussion and possible action regarding investment matters. And we have several reports, including an educational presentation. So I will turn it over to Callan.
Chair,
Yes.
before Callan gets started, I did have a brief update and question that I wanted to bring to trustees' attention. We've been working on getting together some educational sessions for the board that we plan to do at meetings. And so they're sort of staggered out into the future over the course of fiscal year 23. But one question that I wanted to ask the board in relation to those educational sessions is sort of been a theme, but I just wanted to verify that the board is interested in receiving at least one more ESG related training within that schedule. So we've got multiple topics on the calendar. Doris will send out that updated calendar to you later today, so you'll be able to see each of the topics. Basically, the topics are inflation, capital markets, China, interest rates, and the Fed outlook. So those are kind of broadly the topics, but we were thinking that the board probably wanted to have an ESG topic in addition to that. Potentially right before we do the investment policy statement update in probably May of 2023.
So I will turn that over to trustees. ESG on the list or not?
Yeah.
Yes.
Okay, great. Well, thank you for the clarification. And Greg, you can take it away.
Well, and Greg, just a minute. I would just want to say to Robert and Greg and Doris and all, I do appreciate having some educational topics as part of the board meeting. It helps us cover some of our educational requirements, but it also puts us all on the same page. We all hear the same thing. And I really do appreciate that. So Greg, thanks for what you're bringing today too.
Absolutely.
Your turn.
Okay, great. All right, well, it's great to see you all in person and virtually. So I'm Greg DeForest. I've met all of you. You all have met Claire as well. And then this is the first time you're meeting Hannah in person. Hannah's been a square on the screen for a couple of years now. And it's kind of hard to believe that this is the first time we've had an opportunity for her to drive up and with all of the COVID issues. So Hannah's part of our team, and really glad that we're here seeing you today. So we have 2 topics to talk to you about today. The first is a performance update. I'll spend a few minutes talking about capital markets and that sort of thing. Claire will walk through the performance report. And then the second topic we have today is an educational session on other asset classes you could be considering in advance of us doing an asset liability study. So we do a full asset liability study every 3 to 5 years. We're going to be teeing one up October-ish. Once we get your new actuarial report, we'll start the AL study at that time. And before we come back with a bunch of modeling, what's your expected return and risk return trade-off, one thing we want to do is say, well, are there any other asset classes we should consider as part of that model? So today, when I start the educational session, the objective is, okay, should we consider any other asset classes? We can come back again to do a more in-depth conversation about any one in particular, and we could add other asset classes that we excluded this time to the extent you want us to do that. Okay. But we'll start that asset liability study in October. We'll present it in the first quarter of next year. So we've got a lot of time. We've got a good amount of lead time to do a bunch of educational work in advance of it. Okay, so that's what we're going to be talking about today. Okay, and to start with the performance overview, and Robert, are you going to share the screen? Was that our game plan? Oh, or Judy? Or, okay. Here we go.
Is this correct report?
That's the one. Okay.
Does your page down button work? You also could use the scroller over on the side.
There we go.
Right.
Right. How about just one more slide forward? Thanks, Judy. Okay, and here we have this chart, this page here, and we're setting the stage about what happened in the capital markets through the end of June. And the purpose of it is to put your fund's performance into context. Here we show the quarter, year-to-date, 1, 5, 10, 25-year returns for broad asset classes. What are the big takeaways here? Over the quarter, there was nowhere to hide in the capital markets. U.S. stocks down 16%, international stocks down a little less, 15 to 12%, depending on which market you're looking at. And importantly, look at the fixed income component here. So we have 2 consecutive quarters of the Barclays aggregate down about 5% each quarter. That's a historic sell-off. We have not witnessed that in 40 plus years. And it really raised the question, okay, what sort of diversification are we getting between different asset classes, right? The stocks and bonds are supposed to move differently from one another. And in the first quarter, and really for the first half of the year, that hasn't been the case. And that hasn't been the case because the same thing is causing markets to sell off. Increasing interest rates, the discount rate going up because the Federal Reserve is increasing interest rates to bring down inflation. And it's causing the future value of any cash flow to go down. So whether it's a stock, whether it's a bond, whatever. So that has really, through the end of June, been the number one driver in the market. And I remember the last time we spoke, I kind of said there are two themes going on: rising interest rates, that's affecting the price. And then also the next theme coming in is, okay, are we going to be in a recession because of rising interest rates? And what's the impact on the price of securities if we do enter a recession? Will companies be doing well in a recessionary environment? What sort of impact will that have on the stock market, on corporate bonds, the ability for companies to repay their debt? And that is the second big theme we had going on through the end of June. We have the monthly flash report as well. And you'll see that in the month of July, we actually had a huge snapback. Really quite a strong rally. Where we stood at the end of yesterday, the US stock market is about 17% off its lows. And the bond market has rallied as well. And I guess the idea there is that the Fed isn't going to have to increase interest rates as much as people think, and they might be cutting in a year. I personally think that's a little, they might be getting a little ahead of itself right now because we still have inflation print at 8.5%. Right? There's kind of like a doctor, right? When you go into a doctor and they give you prescription, they say, take all your medicine and don't stop just when you feel better. You got to take all your medicine. And we haven't taken all of our medicine yet. So I think there's a little bit of a time to run with that. On a year-to-date basis, you'll see that the really meaningful negative returns through the end of June with only a couple bright spots. One thing I'll point out is NCREIF property, so that's real estate. We've got our real estate portfolio, and real estate's been doing well for two reasons. One, it's an inflation hedge. It's supposed to go up when inflation goes up, and that's because we don't like it, but rents are going up, and if you're an owner of property, you do well when rents go up. That's one reason, but the second reason is also the lag of valuations. So there are two reasons that real estate has been doing well on a quarter and a year-to-date basis. And you'll see the other thing that's positive here for the year-to-date basis is private equity. We're going to spend some time talking about that. And then commodities. Well, no surprise there, right? The price of oil is really driving commodities price quite a bit on a year-to-date basis. I'm going to flip ahead one slide, Judy. That's okay. Okay, so real big sell-off, stocks and bonds both. Now let's ask a question. Well, if we have this big sell-off, are we ahead or behind when you compare the returns to the beginning of the pandemic? And even though we have this big sell-off, we're still north of where we were at the beginning of the pandemic. And that's true for the stock market and for a hypothetical 60-40 stock bond split portfolio. So we had this sell-off, but we're still in positive territory. And that's why when we look at your 3-year returns, your 5-year, your 7, they're still really robust, even though we have a negative year-to-date return. On slide 5, Judy, we look at a few statistics that over the long run should drive returns. Economic growth, inflation, yields. I could spend a lot of time talking about this chart, but I'll try to be brief here. We've seen 2 consecutive quarters of negative GDP growth, but just slightly negative GDP growth. And they're negative because of some, let's say, accounting reasons. Imports or exports in the first quarter. The increase of imports actually, when you count through it, makes GDP negative. So all of those containers off the coast in Southern California came on board. So curing of the supply chain actually made our GDP print look negative. Second quarter, it's a lot about restocking shelves and not restocking shelves. So was today the day that Target released earnings this morning? Yeah, Target released earnings this morning. And they said, we had to mark down a bunch of prices of things because we had too much inventory. And so that sort of activity had a big negative effect on GDP in the second quarter. So a lot of people look at this and say, okay, 2 negative quarters, but are we in recession? No, it's a lot of accounting noise, but this doesn't mean we won't be in a recession in 2 more quarters. Right? So that's what's going on in economic growth. We saw a big backup in yields because inflation remains stubbornly high. And on slide 8, Judy, here's the chart that I kind of found interesting. Interest rates going up because inflation is stubbornly high. Let's look at these 2 lines. The orange line here is inflation. And the blue line is the Fed funds rate. So the big tool that the Fed has in controlling inflation over time is, the growth of the economy is the Fed funds rate. A couple observations here. Most of the time, the blue line is north of the orange line. So if you want to slow an economy, if you want to control inflation, generally it means the Fed funds rate has to be above inflation. Inflation's 8.5% right now. We're a little off this peak where we peaked at 9.1. Last month we came in at 8.5. It's coming down, but for it to stay down, that blue line should be above the orange line. So that means we have a ways to go. A lot of people think the Fed funds rate will end the year at like 4%, plus or minus 25 basis points or so. And it'll stay there until inflation is below that 4% number. And that's the big question for us. Will inflation fix itself, or will the Fed have to continue to put the brake on the economy to have inflation come on down? Now, thankfully, oil is already off. Price of gasoline is down about $1 a gallon already. That's a huge component. That's a huge inflationary component. But wage inflation has not come off yet. And that's something that's only really controlled by the labor force. So we should anticipate continued increasing in interest rates. I'll just highlight a couple things on slide 9 here. Big divergence between the performance of growth stocks and value stocks. We have managers that do both, and you'll see that their performance is wildly different from each other just because of the ponds they're fishing in. Growth stocks or value stocks, very different. Energy and technology operating very differently from each other over the last several quarters. And you'll see that with the managers. Within the fixed income market on slide 11, there was no place to hide in the bond market, kind of negative across the board. For the 1-year time period, there are a couple areas that actually have a positive return, though. One is inflation-linked bonds, kind of interesting, and then levered loans. Levered loans have a floating rate component to them, so rising interest rates, they defend a little bit. We're going to spend some time later talking about this in the second part of our educational presentation. And then real estate continues to do well on slide 12. Valuation and inflation components are driving that. So that's kind of the general backdrop. Now we're going to change gears, unless there are questions or comments. And we're going to talk about the plan in general. And that starts on page 14.
Okay. Great. So the chart on the top here, I think, is always a nice place to start as we shift gears to look at your performance and what the capital market environment has meant for the performance and the total asset value of your plan. And if you look at the far right of the chart on the top, and the blue line shows the total ending market value for the Mendocino investment program over the last 15 years. So on the far right, we look at just what 2022 has meant for that ending market value. And you can see, of course, Given the capital market environment, we would expect negative investment returns. That's what we've seen in the first half of the year. And from a dollar perspective, that has meant a drop in total asset value. But to Greg's earlier comments and reflective of the charts that we saw with returns for the S&P 500 index and returns for a balanced portfolio over the last 2 years, we've seen the market value fall, but it's still well north of where we were before the downturn at the beginning of 2020. So the portfolio has certainly benefited from the strength of the capital markets that we've seen in the last 2 years, and that remains true even with the negative investment returns that we've seen in the last 2 quarters. The chart on the bottom of the page captures total plan change over the full fiscal year. So we're looking at performance as of the end of June, which does mark the end of a fiscal year for the program. And the Mendocino investment program started the year with about just shy of $696 million in total. Over the course of the full year, experienced investment results of negative $67 million, and then paid out just shy of $7 million in benefits over the course of that year. So as of June 30th, the plan was at $622 million in total. And if you look at the net new investment column, that captures all the money that moved around within the portfolio over the course of the year. There's actually a fair amount that happened in the course of the year. 2 rebalances and the funding of the infrastructure portfolio, the completion of that funding. So all of these from a policy perspective, and also as we've seen the capital market movements, have been positive for the portfolio. Importantly, the IFM, so the second infrastructure manager, was funded in the 4th quarter of 2021. So remember, you put money in the queue to be called by IFM and JP Morgan. JP Morgan called Capital first in 2021, and then IFM called just at the end of 2021. The decision to add infrastructure to the portfolio, which was just in 2020, I believe, or end of 2019, was a good one. So as we've seen, the capital markets pull back, having that allocation to infrastructure has been a positive for the total portfolio return. And then I mentioned the rebalances. So at the end of 2021, over the kind of December, January time period, given the strength in the equity markets that we had seen leading up to that, you did reach tolerance bands, and the plan was successfully rebalanced, so out of equity into fixed income and real estate. Just as we started to see the capital markets turn the other direction, equity markets go down. So at the end of June, you actually did rebalance a bit again out of fixed income and into equity as equity market values had been depressed. A lot happening in that net new investment column over the course of the year. On page 15, we look at the actual asset allocation of the plan versus the strategic target as of the end of June. And you'll note that all of the asset categories are broadly in line from an asset allocation perspective with the strategic target, with one modest overweight, and that's to domestic real estate. So as we've seen domestic equity and fixed income market values decline given the capital market returns and positive returns from your real estate managers, real estate is slightly overweight. So that's at about 15% as of the end of June versus 11% for the target. As Greg mentioned, we did see positive returns out of equity and fixed income in July. So that's come down a bit, just under 15%. So a little bit overweight, but notably within the tolerance bands outlined in your investment policy statement. On page 16, we look at the asset categories that the plan is currently invested in, and those are circled in orange, as well as other asset categories that other public pension plans invest in. And this is related to the second discussion that we'll have today around asset categories that you could consider for inclusion in the upcoming asset liability study. So you'll note that one thing I find interesting is kind of that bottom line that says the percent of group invested. So that tells us the percent of public pension plans in this peer group that hold an allocation to each of those asset categories. And what stands out to me is that the asset categories that you currently are invested in really cover the ones that are most common. So almost all of the public pension plans invest in domestic equity, domestic fixed income. About 72% hold an allocation to domestic real estate, international equity. And then over on the far right, that additional real assets bucket, that covers your infrastructure allocation. The categories not circled are ones that we'll talk about, notably private equity is there, which at the bottom you'll note that about 25% of public pension plans have an allocation to private equity, and the others are similar. So not everyone has an allocation, but some do. So that's kind of good backdrop for our conversation in a few minutes. On page 17, we look at the market value of the plan and all of the individual investments as of March 31st and as of June 30th, and how that changed over the course of the quarter. So at the very bottom, you'll note that during the quarter, the plan went from about $686 million to $622 million. Investment returns accounted for a drop of about $63 million. And then the net new investment column, you see just shy of $1 million that left the plan to pay benefits. And then in that net new investment column, you'll see the rebalance that I referred to earlier, moving a bit of money from fixed income to equity, and also a bit to real estate as well. The last thing that I like to note on this page is just the balance of within each asset category. Are you pretty evenly balanced between growth and value, evenly spaced among the managers as is intended? And the answer to that is yes. So Greg mentioned that we've seen value stocks outperform growth stocks in recent quarters. Part of the rebalance executed at the end of June did take that into account, making sure that you remain balanced between growth and value within each asset category. On page 18, we get to performance. So performance for the total plan versus the strategic benchmark and versus that public fund peer group. And you'll note for the last quarter, the absolute return for the plan was down 9.25%. And that actually outperformed your strategic benchmark. So in a down market where the absolute returns are certainly disappointing, you've actually fared pretty well versus that strategic target. Altogether, your managers did work to outperform. And you've also fared well versus other public plans. So the blue dot represents the performance of the Mendocino portfolio, ranked 29th within that peer group of other public pension plans. Over the last year, so that does represent the fiscal year, down 9.7%, slightly behind the total fund benchmark, but again, still ranks right around median among other public pension plans. And then overall longer time periods, 3, 5, 7, 10, 15, performance has been very strong versus both the strategic target in absolute terms and also versus other public plans. So across all of those time periods, landing at the top of that peer group, 9, 17, 15, 9, and 11. Pages 19 and 20 look at individual fiscal year returns. So that's the last 10 fiscal years. And there's two things that I want to point out here. So the first is just a reminder of the strength of the returns experienced in just the previous fiscal year. So fiscal year 2021 ended June 30th, 2021. The plan was up 32% over that previous year. So I think that's good context for the negative 9.7% return that we've experienced in this most recent fiscal year. When we think about the full last 10 fiscal years together, the other thing I note is that there's been 2 fiscal years that have been negative absolute performance. The other 8, we've seen strong gains. So all of that together, pretty consistent with the the line trend of total market value being up and to the right over that time period. And then I'll skip ahead to page 23. So here we look at attribution over the last quarter and then the fiscal year at the bottom. So what's driven the outperformance or underperformance of your strategic target by asset class? And in the top chart, you'll see attribution for the last quarter. So the plan was down 9.25%. I mentioned that outperformed the strategic target, which was down 9.8%. And the key driver of that outperformance was the manager effect. So implementation with your active managers. The domestic equity asset category in particular did quite well. So in a down market, your domestic equity managers in aggregate protected value on the downside. Your fixed income managers did underperform the Bloomberg Barclays aggregate, and we'll see that, but that's really no surprise given the capital markets. So in this market environment, in the last quarter, we did see a flight to quality. So allocations to corporate bonds, high yield, underperformed like duration treasuries. Your active bond managers do have allocations to those asset categories. So just about every core plus bond manager in the universe underperformed the Bloomberg Barclays aggregate in this quarter. So not a surprise there, but did detract from that manager effect. And then the other notable underperformer or detractor in that manager column is infrastructure. And I point that out because it's a bit of a nuance. So there isn't a great benchmark for your infrastructure managers. We use the same benchmark as we do for the core real estate managers because it's valuation based. There's some consistency in driver of return over long time periods. But in the recent time period, a little bit of mismatch between the benchmark and the performance of your managers. We still think your managers have done well in that asset category. Yes.
Hi, Jim. You have a question?
Yeah, I just had a quick question on the slide before that where we have our targeted risk versus the actual risk. I'm just kind of wondering for how well we did in 2021 and what we're experiencing in 2022. Is there even kind of a ballpark estimate of how much of that is attributable to this increased risk?
Yeah.
Page 22.
22. So the risk return chart, and I would just note that, Jim, what we're looking at here is over 15 years. And I bring that up because, you know, one thing when Claire was talking about slide 19, a bit of the history of our investing here has been that, you know, historically, we had been very reliant on the US stock market and public market assets. And because of that, over 15 years, we were more volatile. We either had high returns and high risk or low returns and high risk. And you see that in the individual calendar year returns. And when Claire was walking over, you know, slides 19 and 20, you see back in the day and on slide 20, we were either in the top or the bottom ranking because we were so reliant on public market exposure. So that risk return chart is over 15 years capturing all of our history. What's notable, and I'm sorry, Judy, for hopping around so much, is notable on slide 19, we have a big drawdown. And you know what? We're landing right in the middle of the peer group now. And it's because we've done things like increased our real estate exposure. We've done things like adding infrastructure. We took down some of the active risk we have in the US equity portfolio as well, with a big allocation to US large cap stocks, not as much active in that area. So I think over the years, we've changed things. You know, we're driving a big ship, and we kind of changed it over time in the pointing of the direction. And I think it was kind of noteworthy that this is a big downdraft. if this portfolio looked like the way it did 4 years ago, this year's fiscal date return, we would have been probably down in the bottom decile of peer group performance. But we changed it a little bit, so our volatility today is probably not completely reflective of that total 15-year volatility number. That is a long-winded way of saying that.
Thank you. And I'm assuming when we do our asset liability study that will we have that risk exposure kind of for a tighter time frame that we can look at to see exactly what you described?
Yes. Yeah, and we could even add 2 charts here. For page 22 next time, maybe we'll add a 5-year and a 15-year. Well, we kind of want to show like the longest time period we can, and to kind of anchor ourselves on the long-term goal of the plan. But I think it could be informative if we show a shorter time period or long time period for risk.
Hey, Greg, I've always actually liked that chart. It's one of the ones I seek out when I'm looking at your guys' reports, and I remember it driving the conversation we had when we were looking at diversification in our portfolio to see what other asset classes or places we could invest in. I'm actually very pleased with this report regarding our decision, which was very deliberate and intentional to invest in infrastructure. So I'm also looking forward to the study to see what other potential ways we could try to drive down that volatility. And maybe less sharp turns and more, like you said, guiding a very big boat.
Yeah.
Okay. So the last couple of comments I want to make are on slides 24 and 25, just to focus in on the individual manager performance before we do shift gears to that topic, to the discussion of asset categories for inclusion in the asset liability study. So on page 24 here, we have performance for each of the individual asset categories and investment managers within your domestic equity bucket. And overall, domestic equity as a component of your portfolio was down 15.8% for the last quarter, down 12.7% for the last year. Certainly negative absolute returns, but consistent with what we've seen in the capital markets. But again, your managers in aggregate, the implementation of this portion of the portfolio has been very successful, both in the near term, in the face of negative markets, and over the longer term, outperforming the Russell 3000 index over all time periods shown here. So notably in the last quarter and the last year, your small and mid-cap managers, which are implemented actively, did together outperform their benchmarks and drive that outperformance of the total domestic equity portfolio versus the target. So that's good news. The one manager that I want to point out is AB US Small Cap Growth. That's the one manager that's underperformed in the last quarter and year. Not something we're concerned about, but I want to mention them for 2 reasons. One, their underperformance. So the key driver of that is the fact that they're pretty true to their style. So they've been true to that growth style. They haven't drifted core. They're sticking to their stripes. And because of that, that's been a headwind to their relative performance. So Greg talked about sectors that have driven performance within the US stock market. Energy has been the sole positive performer over the last year and year-to-date time period. All other sectors, so the sectors that are traditionally growth sectors like healthcare, technology, those have been quite negative. So AB's allocation to those sectors has really been the driver of underperformance, but consistent with their mandate to be a growth manager. And over longer time periods, they've outperformed. So wanted to mention that, no concerns with their performance at this point. But also wanted to bring up that there has been an announcement with regards to their team. Again, something we're watching, but we're not concerned about. A longtime co-CIO for the small and mid-cap growth strategies at AB has announced his retirement. He'll be retiring at the end of 2023. We have a long runway to that. His co-CIO, a woman by the name of Samantha Lau, will be taking over as sole CIO of those strategies. She was named co-CIO in 2014, which is when they implemented pretty long-term succession planning for these strategies. So certainly something that mitigates any concern there, but we do want to watch the transition as we move closer to those retirement dates. So wanted to bring that up, but not an imminent concern here from our perspective. And then the remaining performance is captured on page 25 for the remaining investment managers. So we have the international equity managers at the top. Mixed performance based on style and investment strategy within international equity. But again, nothing that stands out to us as inconsistent with the mandate for each manager. Pleased to see Mondrian have a good performance in the last quarter, protecting on the downside. They have more of a value tilt to their portfolio. So again, consistent with what we'd expect. Oakmark tends to be top or the bottom, first or the worst, and underperforming in a negative market environment. Again, something we're watching, but not concerned with it. I mentioned your fixed income managers, Dodge & Cox and PIMCO did both underperform the Bloomberg Barclays aggregate in the recent quarter. Dodge & Cox just about matched the benchmark actually, but together underperformed. Both actually landed at the top of the peer group. So when you look at core plus bond managers, I mentioned just about everybody underperformed in the recent time period, given allocations to corporate bonds and any high yield exposure in a flight to quality environment. So no concerns there. Together, they've paired well and outperformed the benchmark over a long time period. And then infrastructure and real estate, the big thing that stands out is the positive returns. So real estate up 27, almost 28% over the last year. Most of that for both of your managers driven by appreciation. On a go-forward basis, we'd expect return for these managers to be driven by income more than that, 25% return out of appreciation per year is not the long-term expectation. And then we have total fund returns again at the bottom over all time periods. I'll pause there. We have a lot to get to on the agenda, so that mostly wraps up my comments for June 30th, and I'd like to take a quick look at the July flash report, if that's okay with the board. Any questions before we move on? I can just speak to it if that's easier, Judy. Yep. You can just go to the last page. We did include the July flash report here and wanted to point to the return for July rather that Greg already alluded to. The total fund saw a positive return in July of 4.4%, slightly behind the total fund benchmark, but that's with a temporary flat return for the real estate managers. So just a very different picture than we looked at the end of June. So worth noting, over 3 years, the return remains positive and overall longer time periods as well. So we'll continue to watch the capital markets here, but we have seen that shift, and I think this is where rebalancing has come into play well as well.
The educational section. Bring that up.
Okay. So this is going to be a little bit of a whirlwind discussion. We're going to talk about a few different asset categories in relatively compressed time. And if there's anything you want us to delve in greater detail at the next meeting after that, we'd be glad to come back and do that. Or if you want to slow down and spend more time on it today, that's fine with us as well. So on slide 1 here, just setting the stage, This education session is in advance of the asset liability study. We know we currently invest in US and international stocks, fixed income, real estate, and infrastructure. And the question is, should we be investing in any other broad categories? Claire alluded to the fact that we look at that chart that shows what other public funds invest in. One of the ones that others invest in that you don't, private equity, that's kind of a big category. Private credit has been popular of late, and it's been increasing in popularity. And then because of inflation being a concern, there's a lot of talk now about public real assets and then TIPS. So we're going to focus on these 4 asset classes. We had the luxury of editing this before coming to you. So we decided what to talk to you about, right? And we could be talking about probably 15 other things as well. And we'd be glad to do that too, whether it be hedge funds, global fixed income, commodities. Yeah, exactly. And we could talk about that too. But when Claire, Hannah, and I sat down and thought, okay, but what's something you would actually do from our point of view? These are the 4 that we thought of, okay, that you could do. And this is also not necessarily an endorsement for us that you do any or all of them too, right? I think you've had a lot of success over the years of not chasing fads and moving in increments. And the last time we did this, we added infrastructure, and we to the 6% target, so kind of the incremental add, and it's worked out great. And if we add one other thing, it's probably that sort of thing. Let's add one other thing, 5 to 10%, or add nothing at all because what you have is pretty good, right?
Greg, private equity was one of the other ones that we pursued pretty rigorously last time, right? And then we chose infrastructure.
Indeed.
Okay. All right.
Yeah.
That's what I remembered. I just want to make sure it's correct.
Yeah, absolutely. We took a close look at that. We also looked at something called MAX, multi-asset class portfolios, and hedge funds. Those were a couple other things that, for different reasons, we didn't think they were a great fit, and in particular with hedge funds and multi-asset class portfolios. But I was very happy with that outcome as well. Before we get too long in the tooth here, you'll see that this presentation we have in front of you is, you see it's Callan College. You see that down at the bottom there? This is a bunch of material we have that's educational session we provide to our clients like you. And we actually have an online virtual session, August 24th and 25th, 3-hour sessions each day. And it's really in-depth talk about alternatives. So if anyone wants to participate in that, you're welcome to. Just let us know and we'll register you to do it. Or I don't know the most efficient way for us to manage that, Doris.
That would be a question for Judy.
We produce a quarterly trustee education and training report.
Yeah.
And at the last page of that report includes all the upcoming educational opportunities that I've been able to identify.
Yeah.
And if they need assistance in signing up for a Callan College or even your annual conference,
yeah,
I can help with that. But
yeah,
I think they all know they can go to Callan directly
yeah,
as well. And that, again, there is no fee to attend those
yeah,
if you're a trustee.
Hold up after the meeting, we can make sure we get to.
Yeah. I've lost the what? Quincy King. Okay. Let me bring my glasses. So
That's right. I'm farsighted. I can see the screen.
Oh, thank you.
So August 24th, 25th, that's next week. So just let us know if you want help registering for it. Okay, and now let's move to slide 2, if that's okay, Judy.
Mm-hmm.
Here we're going to talk about alternative investments and really the rationale of why you would consider them. And one of the huge themes is that over the past decade, we have been in this perceived low return environment. Interest rates are low, valuations can only go up so much more. How are you going to make money going forward? All of that has motivated investors to look at alternative asset classes that have a higher expected return because they have an illiquidity premium associated with it, right? And so that has motivated people to look at private equity, private credit. Concerns about inflation have pushed you towards real assets, and then hedge funds. If equities can't produce a return, why not invest in hedge funds? It's something that we haven't been quite as strong proponent as others in the industry, because they frankly just really haven't delivered as much on a net of fee basis historically. So we're going to spend a few minutes talking about these, and I'll flip ahead to slide 3. So private equity, the first category here, in why do people invest in private equity? Well, it's the prospect of having a higher return. And at the bottom chart here, we see the returns historically through the end of March for private equity as an aggregate, and then the S&P 500 put in an equivalent way as private equity. And you'll see here the blue for private equity. Historically, there has been about this 1 to something percent premium for private equity over time. And a lot of that has to do with the illiquidity premium. You should make more money if you can't pull your money out. And then the idea that there's value creation through the exercise of private equity. So private equity has had a little bit of an alpha premium over time. The next chart here, we talk about private credit. And a lot of the interest in private credit is really driven by the same thing, the idea that, well, I can make more money in private credit than I can in a fixed income portfolio, traditional public market fixed income portfolio. A lot of money has moved into private credit. And you'll see that the growth in the top chart here, you see the growth rate in that asset category. And on the bottom chart here, you look at, well, here's the yield you can get in these private credit strategies. The yellow line is the average yield we've gotten historically, and the blue line is where we're at today. So we're not getting as much yield as we had historically with private credit. A lot of money's gone in there, so that's one thing that we do have a concern about. The second thing is with the general increase in interest rates, that whole argument that interest rates are low, I need to go invest in private credit to give me some real yield. With treasury rates going up now, that argument isn't quite as strong as it used to be. We could look at real assets in the next chart, and here we just use real estate as a kind of as a component of real assets. Cap rates have come down in real, that's kind of like yields in the real estate market. And it has been a great stabilizer over time, but valuations are a little high right now in the private real estate market. On slide 6, let's look at the size of the private market relative to the public market. You see that the private markets are still quite small when you compare it to the public market here. Now, a whole bunch of caveat with these numbers, right? We're saying real estate is a $1 trillion industry. We're excluding things that are not owned by institutional investors in that, like funds not owned by institutional. We would, if you didn't own this property, we would be excluding this property, for example. So there's a little bit of a caveat with this data, but private assets do remain quite a bit smaller than the public markets. Also, every once in a while, I look at these numbers and kind of note how big the public markets are too. I mean, $123 trillion for public equities, $111 trillion for public fixed income. We're talking about huge pools of assets. Okay, so now let's flip ahead and spend a little more time talking about individual asset categories here. So what is private equity on slide 9? Private equity is the investment in companies, the ownership stake in companies that aren't publicly listed. They're not Coca-Cola, they're not listed on an exchange. They are privately held companies. But at the end of the day, what you're doing is you are owning a company that otherwise you couldn't get access to. You do it because there's the idea that you can outperform public stocks, publicly rated stocks, and that there is this value creation by private equity companies. The private equity company comes into an otherwise, privately held organization, and they change it. They put a bunch of money in, they merge companies, they fire people, they have some sort of value creation. That's the value-added argument about private equity. Now, there's plenty of counter arguments to private equity, and one is fees. Fees are high. You got to pay. You got to pay for that. The other is illiquidity. So you can't just pull money in and pull money out of private equity, just like our real estate portfolio right now. Real estate portfolio, we're a few percent overweight. We really can't fix that like this, right? We're in the real estate, we can put in the queue, maybe get back money in 6 months. Private equity is even less liquid than our core open-ended real estate funds. So that's another component about private equity.
And infrastructure is similarly illiquid as well, correct?
Very much so.
Yeah. Once you're in for the long term. Yeah.
You are. And so we've ramped that up over time, this exposure to real assets, real estate and infrastructure, and illiquid assets. So our target now is 17% between the two. So, $1 out of $5 we have, $1 out of $6 is in assets we really can't rebalance on a periodic basis already. And that's before putting money into private equity. If you would put money into private equity, 5 to 10% allocation would seem to make sense. Anything less than 5%, why do it? Anything more than 10%, well, that's becoming a pretty big allocation. One other thing about private equity, it adds a little bit of complexity to the investment program. With our core open-ended real estate funds, we give them money, they buy and sell properties over and over and over and over again. With private equity, every 2 years, you need to make a new commitment to someone else. Every 2 years, because the private equity funds you invest in raise capital, deploy, return capital. Raise capital, deploy, return capital. So every 2 years, you're going out, putting money into a private equity partnership, and it lives for 5, 10, 15 years. But every 2 years, you need to go pick another one. So there's a complexity to it. It adds to staff time and contracting and legal and managing capital calls. So there's a staff component to it, and then there's an oversight selection of investment component to it.
Since they may be a limited partnership that we would be investing through, would that create, I want to call it AB 2833 disclosures here in California? Do you know what I'm talking about?
Yeah.
Okay. Would that be potential with that type of limited partnership? Because that is actually an additional item that staff or somebody would need to deal with as far as the reporting for things like carried interest and fees. Fees disclosures on alternative investments are very big in California. There would be some reporting requirements for us.
Spot on. Yeah, and that was a big deal like 5 years ago that came out, I think. Yeah, so there's an additional reporting component to it too. And there's a little bit of headline risk to it too. Like if we would invest in private equity, we would say, well, I think I can make 9% in private equity versus 7.5% for stocks. It makes sense over time, but you also talk to your constituents and say, I'm paying someone 3 to 4% in fees to get to that. And some constituents don't like that at all. Some constituents don't like the companies you deal with. Private equity has a certain unpopularity to it too, with different organizations you deal with. So that's some of the pros and cons about private equity. On slide 10, but the returns have been there. right? It's been justified. It doesn't always look like this. There's certainly time periods where, especially coming out of a big downdraft where the public market will lead, they'll boom, like this month, public equity up 17%. Private equity won't be up. So you really got to look at that 7, 10, 15-year time period to show the value add of private equity over time. And on slide 11, Judy, when you add private equity to a forward-looking return estimate in a capital market line, in a risk return framework, it generally pushes the projected returns up into the left because it has lower observed standard deviation than public markets, and it has a higher expected return. So from a very academic standpoint, you add a new asset class, you become more efficient, and it would move this generally up and to the left. The question is it up and to the left enough for you to overcome the other administrative issues, the fee issue, any sort of headline risk associated with private equity? And on page 12, we list out a whole bunch of the kind of the risk return components that we talked about here. Illiquidity issue over time. Returns are good, but it's really hard to benchmark private equity. Is it being successful? A little bit like the infrastructure investment. Like we don't have a great benchmark for the infrastructure, so we use the core open-ended real estate fund, right? So there's we would come and talk to you, and it becomes performance measurement just becomes a little more opaque, let's say, with it.
Hey, Greg, I see Trustee Jurdy has a question or comment.
Yes, thank you.
Yeah, hey, Greg. Well, I wonder though if private equity looks better than public equity because it's you can't sell it in a downturn because you're locked in. And I wonder if it also makes public equity look worse in a way because when we have to rebalance the fund every month and you can't take the money out of the private equity because you're locked in, so it's public. Let's say the public equity does well and it's out of balance in the fund. So we've had times where we pulled money out of public equity to rebalance the other funds. So in a way, it kind of hurts our public equity returns because we're pulling money out, when it's doing well. And I could also see in a downturn, that it's showing bad returns on the public equity, but it's not reflecting the perhaps the real value of the private equity because it's not on the open market. It's not being traded on a daily basis in the same way. And so it just there may be characteristics that make the private equity look more enticing than it really is.
Absolutely. The smooth valuation of private equity, the non-mark-to-market, makes the standard deviation look artificially low. In reality, if the private equity companies had to go out and sell the companies today, they wouldn't be valued at what they were at the beginning of the year, for sure, right? So that the true economic exposure isn't captured on a quarter-to-quarter basis, for sure. So on slide 12, we have a bunch of the pros and cons. In slide 13 here's just an image of how private equity works. You're a limited partner. You would invest in a limited partnership created and run by a general partner. So put any private equity fund name here, general partner, KKR, right? They're the general partner. You're a limited partner, and you would invest in an individual fund, which would then go out and invest in portfolio companies, an individual company out there. So you go into a fund and they might have 20, 30 investments within that individual fund. Most of the time, an investor of your size, you would invest, you could invest directly with a limited partnership, but you could also invest in something called a fund of fund. So above the general partner, you actually invest in another manager who goes out and picks a bunch of on general partners, thank you. And then that way you're diversified. You don't have, because you only have so much money to put to work. And the idea is they also have better access to top performing general partners than you will just going directly, going knocking on the door saying, Sequoia, will you take my, $500,000? They would say, no, thank you. We've got plenty of investors. But the fund-to-fund manager has a 20-year relationship with them, and they'll take some capital from them.
Does that impact the fees if they're going directly to the fund? I'm assuming so.
At least 1% more.
Okay. And does that absolve our staff of having that much more involvement in those types of decisions?
It does, but staff still needs to deal with the fund-to-fund manager and the reporting. And you would still make commitments to fund-to-fund managers every 2 to 3 years. And you need to make, on the next slide, you need to make these commitments year over year over year, because your exposure to private equity changes over time. If you made this one investment in a limited partnership, the yellow line here, they call it the net asset value, the NAV. This is your market value exposure. You make a commitment to them, and they don't call most of your capital until 4 or 5 years from now. It kind of hits a high watermark, and then it goes down because they start returning capital to you. So to make, and at the end of the day, we want that your exposure to be flattish. So you have one curve, another curve, another curve, another curve. Every 2 to 3 years, you're making a commitment, and then you average them all out. You come with a more stable allocation, exposure to private equity over time. This is what adds a little bit to the complexity of it, the whole life cycle.
Greg, this is Richard. Is there a way to understand these managers if they have, quote, skin in the game, like we give them a few million, what part of their actual company income is off fees versus off them putting money into projects they're putting our money in?
So redirect me if I'm missing this, Richard, but if I invest with a general partner, the general partner will tell me how much money they are putting in the fund.
Mm-hmm.
So if they have skin in the game in their own fund, but they also make a lot of money on being successful. They have carried interest. So they make 20% of any return you earn over 6 or 7 or 8%. So they'll tell you that before you invest in them. So they'll tell you, okay, if they hit a home run and have a 20% return, they get 4% of that, right? So they'll tell you that in advance.
Got it. And I guess, so the other part of that though is, are they, it's like your brother-in-law calling you up, I just put a bunch of money into this project. I mean, are they doing that? What you're telling us just then was they make money when it works. So obviously they don't make money when it doesn't work. But do they put, their company funds into those projects and share the risk, I guess?
Yeah, they have most of the companies will have their own capital in the funds too.
Yeah.
For sure. They'll have capital at risk. But they'll make more money if they do really well, this carried interest concept.
Yeah.
But they also have a fixed fee. It's the 1 in 20. If they lose money, they still make your 1%, right?
So got it.
Yeah.
Thank you.
Yeah, Greg, along those lines, and I appreciate Richard and everyone speaking up, because I can't see when you're raising your hands or whatever. But when you're talking about returns and costs of private equity, when you talk about the rate of return, is that net of the fees?
It is.
Okay. All right.
It is net of fees over time.
Madam Chair, may I ask a question?
Yes, I can't
Or-
see you. You may ask.
Or comment? This is Jim Anderson.
Yes.
Kind of to Callan, we've been having discussions with Siegel about the maturity of the plan and kind of the life
Yeah.
cycle of the plan. and over the next 15 years, kind of the, some of the difficult decisions that have to be made on investment return versus liquidity and so forth. And it would be really interesting for me, I think that all the trustees when we do the asset liability study, to see in that next 15 years or so, what would be the advantage kind of entry points and exit points to some of these alternatives? Because really our role as trustees is probably going to change quite a bit over the next 15 years.
I think that's an excellent point. So if you're to the point you're in a meaningful negative cash flow position, and you make a commitment in private equity, you still owe, you're supposed to give them that money, right? And
Do you have a definition of meaningful negative cash flow? Only
So-
because we had a discussion about
Yeah.
cash flow at our last meeting.
Yeah.
I'm just curious if you.
I'd say north of 5%. I kind of remember, I might be wrong, you might be a negative 3%-ish.
We're actually, I want to say down about to 1.5, maybe 1.9-ish. I don't have the materials in front of me right now. We've been over 3, I think, at some points in the past. But that was like a one-time sort of blip. I think the average is down maybe about 2, and we're coming in under 2 now. So we don't have what you would phrase as meaningful.
Yeah.
I know Gabriel Roeder Smith, which is an actuarial firm, puts out a little checklist, and they say if you have sustained, negative cash, I think they use 3.5%, then they're like, you need to start thinking about what your asset allocation is, because then you do have potentially some liquidity concerns if you've locked up, 30% of your portfolio in real estate, infrastructure, and private equity or private credits. But so I just wanted to know what you felt was meaningful.
Yeah. So yeah, I like 5% is kind of a rule of thumb for us.
Okay.
But so you got 5% today, but also you need to consider, well, what are you 10 years from now too? If it's a 20 live year investment, what's the cash flow look like 10 years from now? Yeah. Sorry.
Just for clarity's sake, we're somewhere below 1.5%, 1.3, 1.4, somewhere in there.
Thank you, Robert, for looking that up.
Okay. And on slide 15, who invests in private equity? The big orange thing is public pensions. What this is saying is the dollars invested, though, not the number on the left is not. So CalPERS makes, CalSTRS, New York City, New York State. They drive the size of this orange pie here, right? The big public funds, they can really drive the total amount of dollars going in to private equity. On the right, this is like this shows the type of investor in it. And here you'll see that corporate pensions and nonprofits, endowments and foundations actually make and family offices, by the types of investors, they make up a huge component of who's investing in private equity. Private equity strategies on page 16. There are a few different basic food groups. Buyouts, where you take a public company and take them private. Growth equity, where someone's about to growth venture capital. That's what you hear about a lot, but it's not as significant by a size of the company, the industry, as you would think. I think there's disproportionate press on venture as opposed to buyout, which is actually the more stable, larger dollar amount of investments, and then distressed in private energy. Okay, so on slide 19, private equity, you've got illiquidity and their implementation risk, there's fees, the J-curve effect, you lose a little money before you make money, and it takes time to be fully invested. But you're doing it because the returns are expected to be higher over the long run. So that's private equity. The next category on slide 22 is private credit. So private credit is just like private equity in that it's a private investment in, instead of equity, it's in debt. So if a company needs to borrow money, you're making a private loan to that company. Okay. Why has this come about? It's actually kind of an interesting story. We had the global financial crisis. After the global financial crisis, there were regulations made on banks about how much a bank could loan to different companies. And new regulations took that money that would go from a bank to a company, and those companies still need the dollars to borrow. So in come private lenders, people who source individual loans, and they lend money to a company that normally would go to Chase or whoever. Where do those companies get capital to loan? Well, they raise capital from long-term investors, private credit comes about, and it's just exploded. It's exploded because there's a demand for private credit, there was a reduced supply, and investors were looking to increase their rate of return when interest rates were so low. So it became really quite popular over time. It has a lot of the attributes of private equity and not being liquid. It's shorter lived, and it's not quite as risky in the sense that you lend money as opposed to owning the company. When you lend money, a lot of times assets are pledged, so there's collateral behind the loan, just like your house. Your house collateralizes your personal loan in a mortgage, but it's much more of a investment grade or high yield fixed income substitute than it is something that really drives returns at the total portfolio level. Okay, so that's what private credit is. And on slide 25, we have some projected returns for high yield, private credit, and private equity over time. So you'll see that, Callan, we have about a 1% return premium of private credit over public credit of a similar credit quality over the long run. Now, I kind of alluded to it before with the increase in interest rates. The whole argument about I need to be in private credit is a little weaker now because you can get a lot of bang for your buck in fixed income already. On top of that, we don't have a lot of fixed income. We're 21% targeted to fixed income. So anything much less than that, I would become a little more nervous about taking out our anchor in fixed income. If we had 35% fixed income and we wanted to keep 35% fixed income, I think that's a much stronger argument to move to private credit than if you're only down to 21% fixed income in general.
So my takeaway from your comment is that you probably wouldn't be recommending private credit allocation unless you were looking at increasing the overall allocation to
debt.
Debt. Thank you. I couldn't think of that.
Yeah. Yeah, absolutely. Absolutely. That's kind of the big takeaway for me. And it's because private credit does have illiquidity, just like private equity. And there are fees associated with it as well that, on page 28, it's, a higher fee structure, but you don't get the same bang you get for the buck as you do in the private equity structure. So prioritization for me, if you're going to add to the illiquid investments, I think a lot more bang for your buck in private equity as opposed to private credit.
But you don't have the additional reporting concerns with the private credit, or would you? Because you'd still be going into a limited partnership.
You would still have that limited part. Like we would look at it and say, oh, that's credit, not equity, but you're still going into a limited partnership structure. Yeah, there are a couple open-end funds that are trying to be launched now. They're operationally a little more complicated for an investment manager to manage, but most of them are, finite life, closed-end, limited partnership structures. Okay. The last couple of groups we have here are investments in real assets. So the drive for real assets is the interest in real assets is driven by the idea that it's an inflation hedge. It does well when inflation is high or trending higher or higher than anticipated. And it's a diversifier. It's something really different from the rest of your public market securities. One thing that we've always believed about real assets is if you invest in real assets, we want to invest in something that has some sort of economic growth to it, as opposed to something that is just like a levered play on inflation over time. And I bring that up because there's some investments out there that are just, oh, if inflation's high, it's high, if it's low, it's low. But what sort of return is it going to give you over inflation? What sort of real return will it give you? So we've always had an interest in making sure we're investing things that have some sort of justification for a real return on top of it. So a number of the categories are, real estate, you've already got it, infrastructure, you already got it, commodities, timber, and farmland. Given the size of your investment program, we think that the farmland and timber is it's a little too narrow for you. And then the physical commodities doesn't always argue that it should produce a positive real return. Why should oil go up faster than inflation? Why should it grow with the economy? And there's like little argument that it should. For a long time there, we were looking at 10-year returns of oil being negative for 10 years, right? 10 years. And there's a hard argument that commodities should have some sort of economic growth to them over the long run. So on slide 33, why real assets: diversification, return, inflation protection, and providing an inflation return over time. On 34, we plot a bunch of the real assets along a risk return chart, and this is expected returns, not historic returns. On slide 34, a lot of the orange things here are the inflation sensitive securities. You see that they plot pretty neatly along the efficient frontier, or the capital market line, I think is what I should call this thing. And so you've got real estate, farmland, timber, all kind of plotting in a pretty similar area from a risk return standpoint. We have REITs over here to the right. So REITs are real estate investment trusts. They're stocks that invest in real estate. They actually have a really high observed volatility, and they're highly correlated to small cap stocks. So for that reason, they don't provide the same diversification as you would expect in other private real estate or other real asset strategies. Then you'll see the risk return. We have commodities, expected risk return. It's a lot of volatility, giving you a return similar to inflation over time. So real asset portfolios, you can invest in it in one of two ways, either through the public markets or the private markets. The private markets are where we're invested today, real estate and infrastructure, and they provide you different exposure and lowered volatility than the public market. The public market securities, we'll show you a few flavors of it a little further along, and they a lot of times are really good investments for very small investors, as opposed to you being kind of a mid to large size investor. Let's flip ahead to slide 38. And that kind of speaks to what I was alluding to here. So if we work with investors and say, what sort of real asset portfolio should you have? We have kind of like three different archetypes or models. If you're a pretty small investor, you would invest in only public market securities, inflation-linked bonds, commodities, REITs, natural resource equities. So investing in stocks that are somehow linked to energy or oil or gold or something like that. So this is a sort of investor who has, like, let's say $75 million or less. So pretty small, they can't access other markets. If you're kind of a mid-sized investor and you wanted a, so what we're saying here is 100 million to 3 billion. A more diversified real asset portfolio, we have an anchor in there to private real estate. And then maybe you also have tips and a real small piece of commodities and REITs. And then if you're a huge investor, you might have a lot more categories in there. So 3 billion plus, so very large public pension funds might have about half the money in private real estate and some public, and then things like private equity, infrastructure, agriculture, and timber. So we've already built out the infrastructure component here, and we've got the private real estate. But if you wanted to add more, it'd probably be, you know, something a little more that we have in the pie chart in the middle here, tips, commodities, REITs. So in adding that, you can go and you can pick a off-the-shelf fund, a premix of diversified real assets out there. Public market real assets on page 39. But know that they're all really different from each other, right? So here are 4 major providers in this area. And you'll see that the pie charts all, or the, what are these called, SAM charts? They all look really different from each other, right? Some are really fixed income centric. That's the one in the upper left. That has a whole bunch of inflation-linked bonds. So lower return expectation. Some of them are, you know, passive and very strategic. So the one on the bottom left, so they've got REITs, tips, commodities, and natural resource equity. Pretty standard allocation. Some of them are really aggressive. At the upper right-hand chart here, this person has a whole lot of commodities and then a whole bunch of equities in it. And then some of them are really tactical, and that's kind of the bottom right here, where they're kind of trying to shift and time the market quite a bit. And that's the bottom right-hand chart here. Now, one thing about the natural resources equity and REITs, you already have exposure to it. So REITs are a big component of the small cap value market. And natural resources equities, well, they're stocks, and you have the S&P 500 index fund and then active small cap equity. So if you went here, you would be saying, I want to overweight those stocks. I want even more of those stocks. Or I want, so to me, these are less of kind of a pure exposure to something that you don't have. I don't think they're solving a problem for you, because you already have a whole bunch of exposure to these securities. On top of that, your bond managers have the latitude to buy tips anytime they want. Now, they won't always have a strategic allocation to it, but they have the latitude to buy tips when they think it's attractive. So I think some of these asset categories, you already have exposure to them, so I don't know if I would push for it.
Greg, this is Richard again. And when I see it, like the REITs, real estate, is there the feasibility to be more targeted? Like I think of a California housing market as what might be out there in companies that are building houses in the Western United States or in California, or building multifamily complexes or whatever. I mean, is that a reasonable subset to look at within all of this?
Richard, I don't think in this context, because the public real estate companies may not focus on that as much. However, we have started getting more data on private investments, as opposed to a private investment in low-income housing. and some of which is California, and some of it is across the US. So I work with another investor who has a particular interest in that, and we've actually looked at a few of those strategies. And maybe what I could do is I could send you a note with some information on some of that private low-income housing funds that we've seen. So if Richard, that was of interest to you, I would go on the private side as opposed to the REIT side. But one thing I would think about is, okay, what's the sizing of that? How much money would we put to work? I'm currently overweight real estate right now, so there are a whole bunch of things to consider with that. But we have been doing some due diligence in that area.
Okay, well, to me, that'd be interesting. I don't know if there's other members that think that's worthy, but if you have stuff worked up already, I'd appreciate seeing it.
Yeah. The last little category we'll talk about here is inflation-linked bonds. They are the lowest, quote unquote, risk, default risk, and inflation hedging component out there. I mentioned that your bond managers already have the latitude to invest in it, but an inflation-linked bond is a bond issued by a government, here the U.S. Treasury, where the principal goes up and down based on CPIU, and the coupon based on it stays the same, but as your principal goes up, your coupon gets bigger, percent. The actual dollars you receive. That's the way an inflation-linked bond works. They're real simple ways to try to hedge inflation, but with any of these inflation sensitive asset classes, they're exposed to inflation and they're exposed to something else. So let's think about real estate. Real estate is exposed to rent and inflation, but they're also exposed to cap rates, to defaults. They're exposed to inflation and something else. With the case of inflation bonds, yeah, the CPIU inflation, you have that, but they're also exposed to real rates, the price of money over time. The price of money goes up, the cost of money goes up. You still can have negative returns in inflation bonds and tips. So you'll see that, and for the quarter, inflation's 9.25% or 9.1%. But last quarter we had a negative return in tips, and it's because yields are going up across the board. So they're an imperfect hedge, and they still have a relatively low expected return associated with them, real return associated with them over time. The size of the market has exploded. You see that on slide 41, and the inflation-linked bond market is bigger than just the United States. Britain has been a huge issuer of inflation-linked bonds. Well, you also have someone like Mexico issuing inflation-linked bonds. So some investors decide to invest in global, on the right here, the global market, inflation-linked bond market. Others want to just, hey, I only want exposure to US CPI. I don't care if Mexico has inflation or not. I care if US has inflation or not. And so some of them are more focused. Given your relatively low allocation to fixed income, I don't know if I'd add tips, and your managers have the latitude to invest in it, but because inflation's been running hot, some people are talking about this, wondering about inflation bonds. So I apologize. I think we took more time than we had been allotted today, but we wanted to kind of run through these few different asset categories and see if there's interest in learning more about one or the other, or if there's consensus about us modeling one asset class or another in the upcoming ALE study.
Loved the colors last night, didn't I?
It was a very pretty, colorful
Yeah.
one. Okay.
I have a general question overall. We were talking about the in-start performance summary. We circled the ones that we are invested in.
Yeah.
We looked at the public funds that are invested in other asset classes. There's different categories you have there to be alternative, global, equity, and which ones of these, if not all of them, would be considered alternative? Because it looks like 41% of our other people that invest like we do are in alternative.
So those would mostly be hedge funds.
Just hedge funds would be considered.
Yeah,
alternative.
and then private equity is a different bucket. Real assets, we have it as a different bucket. And so a lot of the alternatives there would fall into something like hedge funds, or perhaps.
So if I'm reading this right, 41% of our comparables are invested in hedge funds.
Well, yeah, hedge funds and other stuff. I'll say that. So we collect data to make our peer groups, and sometimes we don't have 100% visibility on what someone categorizes as alternatives. So that's a little bit of the backstory by that, but I can tell you anecdotally, you know, the kind of the thing that some people have in alternatives that you don't are hedge funds.
Okay.
Well,
Greg, I'm sorry, it's Jerry. Sort of getting the feeling that I had a couple of years ago, that you were nudging us towards private equity. That you presented the negatives on all of these, but we are not yet in hedge funds. I didn't think that we had much interest in that.
Yeah.
But I do feel that maybe you think our decision that we made to stay out of private equity was not the best, that we could have had a higher.
Oh, I apologize if that's the interpretation I was given.
That's only mine.
But
maybe no one.
I wouldn't advocate for you necessarily to increase private equity right now. I think you're roughly 17% illiquids. I think you're in a pretty good place. I think private equity comes with a lot of operational and implementation issues.
A lot of money where people can come to you if they did with the big fund.
Yeah, but if you added any one thing, I would add private equity. I think last time we said if you added any one thing, we would add infrastructure.
Yeah.
Right?
Yeah, we don't listen.
Yeah, and I think that was good. If you add anything this time, I think private equity kind of makes sense, but I'm certainly not pounding the table to add it for a number of reasons. I think you've got a pretty high expected return with the level of public equity you have. If we added 5 or 10% in private equity, you know, maybe it pushes it up a little bit, but I'm not pounding the table saying you need to have private equity.
And when you come back with the results of the asset liability study and are looking at setting the allocations for different investment groups, at that point, they might present something that might have an allocation to it, but they might not. So it really just depends on what they feel might be appropriate based on the size and what they expect the capital markets to be. There are some additional administrative work to those private equity and private credit investments. But I was told, and I don't want to put words in your mouth, that Callan probably wasn't going to really be suggesting any significant alteration to an asset allocation plan we had. They might tweak it a bit, but they weren't coming back with maybe expecting wholesale changes to what our allocation has been.
Yeah, I think that's good.
So let's
done very well for us. Absolutely.
open the conversation to any of the trustees that want to respond to either Jerry's comments or to Greg's presentation. I think it was, it's very informative, of course, Greg, as always. I know that we were talking at one time about, what else we could do to increase our returns. I mean, we talk about that all the time, I'm sure. But the private equity has come up several times, so I'm glad to have that background on private equity. I really appreciate that. I should also ask, and this is a Judy question, if there's any public out there that have any comments on our investment.
There is no public comment at this time. However, Robert has raised his hand.
Yes, I saw his hand this time. Robert.
Yeah, I would point out to the board that any allocation to private equity is going to be underweight for multiple years going forward. And it's certainly not going to decrease the risk in the portfolio.
Okay. Would you say it increased the risk in the portfolio?
Yeah. Yeah.
So the question is always risk versus return. You want to try for a little bit higher return, but at that you're accepting more risk, as always. So other comments, questions? I can't see all of the trustees, but anybody in the room there?
Sure. I'd like to clarify a statement I think Greg made, that we have 17% of our portfolio, what I'll call locked up, is pretty illiquid. Is that correct?
Yep, 17% of your target allocation is in real estate and infrastructure, which is illiquid.
And is that typical for a pension fund like us?
Yeah. I think that's definitely.
What's the range of your clients in that category?
I think we could look at between 0 and 30% illiquid assets, depending on the size, maturity, complexity of the portfolio.
Okay, thank you.
I know I can find this in the reports, Greg, but off the top of your head, can you tell me what our equity versus bond allocations are, rate, relative percentages?
You're 20%, 21% bonds, and so 62% equity.
And then
And that's split between US and international.
okay. And then the 17% you were just referring. Yeah. Okay, great, thank you. Well, I really appreciate, and I know the board appreciates the time and effort you put into not only our quarterly reports, but also our educational session. Thank you very much. And thanks to Claire and Hannah as well for making the trip up. Is it hot there yet in the room?
Well, I think they might have got the air working at least for a bit, so.
It's a little cooler in here now.
Very good, very good. I didn't come in thinking that would be hot and muggy, but it's kind of hard to do this from Zoom. So next time I'll be there. Anyway, next time maybe I can meet Hannah in person, but thank you for coming up, Hannah, and good to see Claire and Greg as well. So thank you. I think it would be a good time to take a bit of a break, but wait till Robert. Yes.
Yeah, I guess I didn't quite understand, maybe I missed it, but did the board actually direct us to bring back a deeper dive on any particular topic? Was that the comment about private equity?
That was not a comment from me about private equity. Anybody else have a deeper dive they want done on any of the topics that were addressed today? I don't hear
Madam Chair, this is Quincy.
Richard. Oh, Quincy. Hi, Quincy.
I'm always interested in finding out more information on all these different asset classes. So none of them stuck out to me, individually as, oh, that's one I absolutely want to hear more about. But if another fund is invested in them and it's something that there's an opportunity for us to consider, I'm always interested in learning more about it. And we, as you have both seen in your time working with us, are very deliberate in every action we take. So the more information we have, the better. And if it's something that other groups are investing in, I'm more than willing and excited to hear about it. But none of them stuck out that I absolutely want to hear more about. But that's my personal take.
Well, at the beginning of Greg's comments, I think you said, there's many things we could be looking at, but you chose these 4. And so it sounds like, Quincy, from what you're saying, that whatever the other possible alternative investments are out there, maybe we want to hear more about them rather than these 4, any additional depth. Is that what I'm hearing?
Madam Chair, I trust that Callan's bringing us the information that they think that we need to hear. So if there's something else that other funds are invested in that they haven't brought in, then
Yeah.
sure, absolutely. But I trust that these are the most popular ones that we aren't specifically invested in, and that's why I like hearing about them. But
Yeah.
Absolutely.
Okay.
Yeah.
And again, if anyone wants to listen to that session next week, you're more than welcome to do it. And it sounds like there's not a big clamoring for private equity. Sounds like my read is there's a little bit of hesitance to move towards it. In our asset liability study, we could model with and without private equity, or we could just ignore it altogether. I don't know if there's, if people want to think about that more, or
They might want to think about it a little bit more. I do see that Trustee Jurdy has a comment, and I'll let him comment, then I'll come back to my question.
Okay.
Dan?
So Greg, personally, I'd like to actually continue to learn more and more about the funds the categories we are invested in. So, we've learned a little bit about infrastructure, but I think it's still a pretty new topic to us. And real estate is a pretty big category, but it's we did get a good refresher on our portfolio because the questions came up, with the downturn in the economy, what exactly was our portfolio invested in? So that's kind of fresh in our minds. But I don't know, that international equity, domestic equity, I mean, I think to the extent that we can keep getting education about what we are invested in and are there nuances to the way we want to adjust those that existing portfolio, I think is always helpful.
great point.
Excellent.
Thank you, Dan. Yeah, excellent point.
So I'm going to chime into Dan's comment. I think nuances was a key word for me, and that's why after I see the stuff Greg has about housing specifically, may come back to the board with that. Not Greg, but me, to see if the board is interested.
Any other comments to Richard's?
Well, yeah, I'm interested in knowing more about not just our existing real estate portfolio, but what are the other options out there in the real estate field.
Okay.
And my administrative question, very quickly, sorry, Madam Chair, is if we did move into that, would we be able to, like a private equity or a private credit, kind of give us an idea of what time requirement might be required of Robert if we undertake something like that, so the board knows how staff time is affected by maybe the increased reporting requirements or something like that, just so we go into it with eyes open if they ever did choose to go that direction, because it could affect, maybe staffing levels or,
Yes. Yes, absolutely it would.
So, Director Rentschler, do you have enough information from this conversation that you can work with Callan on some additional topics to discuss in the future?
Yes, I have an idea that I'll email to them for some additional discussion that I think might address the item that Richard and Dan, or excuse me, Trustee Shoemaker and Trustee Jurdy brought up regarding maybe ways to access sort of a localized real estate market or something based on kind of what Fresno did, and we'll see if that's even something that could be implemented in this type of environment for our plan.
Okay.
And Madam Chair, if I might,
Yes.
I still have a nagging interest in the whole private credit area. And, at least considering in addition to our fixed portfolio, and that might even tie into the real estate and Richard's comments about housing in the state of California and how people are able to get into a house or get credit. I just think of the young people in our state that wind up moving to Texas because they can get an inexpensive house and they can't here. So we're raising our kids, we're educating our kids, and we're saying goodbye to our kids because we've made it impossible for them to live in this state. And I think that's a Travesty.
Thank you, Jerry, for your comments. Well, I think we need to move along. And again, I thank Callan for coming today. And I think at this point, let's take a break. Bio break, get a new cup of coffee, whatever. Let's take a 10-minute break. And if my watch is correct, we'll come back at 10:45. Great. See you in a bit.
Thanks, everyone.
Thanks for your time.
Thanks, Cal and staff.
Nice to see you.
back to order then. And we'll move on to item number 6, discussion and possible action regarding adoption of Board of Retirement regulations. I'll turn it over to Director Rentschler.
Thank you, Madam Chair. The last time the board's bylaws were updated was in 2013. There were multiple drafts here of people who had started revisions, and it had been postponed in part because of the project. And now that we're through a significant part of the project, I went back and started looking at those bylaws again. Because of a number of significant changes that I wanted to incorporate, I actually just started over with a clean document. It is referred to as board regulations because that is now how the serial refers to it, but the board regulations would replace the bylaws. We can call it whatever you like. Some systems say bylaws and regulations. Some just use regulations, some use bylaws. But I also gave you a copy of the current bylaws with some of my notes in the margin, along with a draft of the board regulations for feedback. Because this is a significant change, if there are modifications the board would like to incorporate, this certainly could come back for adoption at next month. But if there are relatively minor changes, we could look at adoption this month with any directed modifications from the board.
I will comment, Doris, that I really did appreciate you putting in the old bylaws with all of your written comments out there, because it helped me understand the changes and where they were coming from and where they were going to. You did have several questions written into those comments, so I don't know whether trustees particularly had an answer to any of those questions or wanted to respond to that, or Doris, if you wanted to go through the questions that you really need answers to before we can move forward. I appreciated what you did by separating out the elections from that. I think you did a wonderful job, and I like the way it ended up.
Thank you. So one of the major changes is that the election procedures are no longer part of the bylaws or board regulations. We've developed a separate board election policy, which is the next item coming up on the agenda. The questions in the margin are not significant concerns to me, unless there was someone on the board who felt that something that was not included needed to be added back into the regulations. And those are really the questions I was asking in the margin is, do we still need this? Does anybody want it? If there aren't any comments from trustees regarding those questions in the margin, then the draft of the new regulations reflect what I think is relevant and covers the administration of the board and some of the specific unique items of our system. But it removed much of the items that seemed no longer to be timely or relevant because it was talking about service prior to 1948, or the election part that was broken off into a new policy. But I'm happy to answer any questions or go into further detail on some of the changes if the board has any questions.
Let's open it up to trustees for questions or comments. And also, Judy, if there's any public in our meeting, if there's any public comments on this particular agenda item about board regulations, we would take those at this time.
I have not seen any public in attendance at this meeting today, so no public comment at this time.
Okay, thank you, Judy. If you have all, if you're satisfied with the work that's been done, I think we would entertain a motion to adopt the Board of Retirement regulations as presented.
So moved.
Okay, is there a second?
I'll second.
Okay. Any further discussion?
Madam Chair, this is Quincy.
Hi, Quincy. Yes.
Just for a clarification, the regulations would have to be, after adopted by us, potentially be adopted by the board, but the election policy would not?
That's correct.
Okay,
The bylaws or board regulations do have to be adopted by the Board of Supervisors. This would simply be a consent item that we would place on an upcoming Board of Supervisor agenda. So they wouldn't technically be official until there's been approved by the Board of Supervisors. There was a potential change in the state law to remove that requirement, but that got stricken from the current assembly bill. So that requirement to have the board regulations approved by the Board of Supervisors would remain. And that was one more reason to split off the election policy. So if we have to make any tweaks to the election policy and procedures, we don't always have to go back to the Board of Supervisors for approval again by having it outside of the bylaws or board regulation.
Well, some of the stuff that was in the bylaws previously, as you noted, there's too much information. Bylaws don't have to contain all that detail. So I appreciate you taking that out. So we have a motion on the floor and we have a second. If there's no further discussion, Judy, would you take a roll call vote, please?
Yes, Ms. Kavanaugh,
Aye.
Mr. Dirty,
Aye.
Ms. Smith,
Aye.
Mr. Cromer,
all right,
Mr. Shoemaker,
Aye.
Ms. Harris,
Aye.
approved.
Yay, we have unanimity of the ayes.
Oh, that's right. Yes, we did. Thank you. Okay, let's move on to agenda item number 7, which is the elections policy discussion and possible action, which no details have changed. It was just removed from the bylaws and put into a separate policy.
It was removed from the bylaws, created as a separate policy, and it did expand and include a little more information regarding some of the timing and the procedures to make it a little bit easier for staff to administer. One of the significant changes was to align with the state elections policy to provide a minimum of 88 days between notice of election and the actual date of the election. So if you have any questions regarding the policy provisions, I'm happy to address those. You can see that what was a couple of pages from the bylaws has now turned into like its own 8-page policy because we did provide some additional direction and explanation.
Comments, questions? No public comment, I will assume, because no public's in the meeting. Is that correct, Judy?
Correct, no public comment.
Okay. So I need a motion to adopt the elections policy.
So moved.
Thank you, Richard.
Madam Chair, I'll second.
Okay, Quincy, thank you. Is there any further discussion? Okay, then Judy, could you do another roll call vote, please?
Yes, Ms. Kavanaugh,
Aye.
Mr. Dirty,
Aye.
Ms. Smith,
Aye.
Mr. Cromer,
Aye,
Mr. Shoemaker,
Aye.
and Ms. Harris.
Aye.
Approved.
Thank you. All right, you got something checked off your list, Doris. That's good. So we will move on to item number 8, discussion and possible action regarding the Information Technology Master Plan. So Director Rentschler.
Thank you, Chair Smith. This item was brought forth at the request of the Proposal Review Committee. The committee narrowed the field down to 2 consultants to prepare the IT master plan, but they did want to get some more board input regarding it. The 2 firms are both over the amount that we have budgeted. Every proposal that came in was more than what we had previously dedicated in the budget allocation. However, we do have other consulting funds allocated that we could reallocate to this project. The two firms are Client First and Linea Solutions. Some of you who've been on the board longer may recall Linea Solutions. They have provided service to MSERA in the past. They completed MSERA's IT master plan leading up to the implementation of the pension goal product and assisted with that project. Client First actually completed a IT plan for the county of Mendocino about 4 years ago, perhaps, that resulted in identifying 100 projects probably that the county has subsequently been implementing. So they do have a high degree of familiarity with the county's network and infrastructure system of which we rely on. And part of the IT proposal is looking at our reliance on county IT infrastructure. Linea Solutions, on the other hand, really specializes in providing IT consulting services to defined benefit pension plans and has an understanding of our pension goal, the pension system, and again, some of the specific issues that pension systems deal with. So with those two broad distinctions, the committee didn't come to a decision on one vendor and wanted some additional input from the board. I have no concerns about working with either firm.
I didn't see that you had the costs associated with those proposals in the memo.
I did not put the cost in the memo. I wasn't sure since we hadn't a contract if the cost was actually something that was disclosable at this point. I'm happy to mention that if Jeff says that it's not a problem.
Mentioning what the cost of the contract would be?
The proposals, the price quotes.
Oh, you can do that. It's not on the agenda today to adopt the contract, but you can talk about costs.
Okay.
Is it proprietary in their document?
I don't know if it would be proprietary. Typically, it would be disclosable, but in other jurisdictions I worked at, we didn't disclose that until a contract was, so a firm was selected.
Just because you made a point that we had allocated $10,000 and these were both over, I think it's relevant to know how much they were over if that's not a problem.
So let me just clarify, if you feel like it's going to impact your negotiations to talk about specifics, then you probably don't want to do that. But I'm not sure that was the question I was asked.
Let me start with saying we allocated, Robert, was it $45,000 total for consultant services for this year's budget? And that was broken out between a survey consultant, cybersecurity assessment consultant, and the IT master plan. We had budgeted $10,000 for the master plan. It is likely that we may not actually complete the consulting contract for one or both of those other services this year. So we do have an allocation of a total of $45,000, which is well in excess of both of these budgets or excuse me, quotes that these firms offered. We'd be looking at needing an additional $5,000 to $17,000 to cover the additional allocation that we would take from one of those other projects that has already been included in this year's budget. So for purposes, the Linea Solutions came in closest to our budget figure as far as what we had allocated. And then the Client First is over twice what we had allocated.
That is helpful to me. Thank you. When I'm choosing a contractor for anything I need to do, I do want to compare prices as well. Trustees, you have questions about the details of these firms that the committee might be able to answer?
I guess what was the specific reason you guys came back to us on this?
They narrowed it down to these two firms, and our committee was Jim Anderson and Jerry, and one wanted one firm and one wanted the other.
Okay.
So rather than making that call, because their scoring was such that they were basically just flip-flopped on those two choices, it was asked that I bring it to the board. Jim has his hand up, Mr. Chair.
Yes, hi, Jim.
Yeah, hi. If I can, at least from my perspective, kind of elaborate a little more on the distinction. And we did both come to the conclusion that as Doris did some additional backgrounding, whichever firm she felt she was most comfortable working with and would get the best work product out of, is that we could support either one. It seemed like Linear Solutions, again, they used to be a pension automation system kind of firm. They have gained a skill set through their staff and so forth where they can address all of the business functions. They've served almost all 1937 Act systems in the state. And so they have that specialized knowledge, excuse me, of pension systems, as Doris or Director Rentschler said. On the flip side, the other firm had done work for the county, and in our strategic planning process, we talked about what services do you buy, what services from the county, what services don't. And so they might have a greater knowledge in kind of how you disentangle any of those services. The other thing that was encouraging from that firm is that they had done a number of projects for the county. And although they weren't as familiar with retirement systems, they clearly had IT expertise and they clearly could learn a number of different topics. They had done land use, they had done really emergency services, kind of the gamut of programs for the county. And so it really was, I think we got to the point where it really was a kind of the sure bet on somebody who's worked with retirement systems, or the one who's probably closest to our strategic planning direction in how are we going to work with the county.
Linear Solutions has broadened their consulting services, and they actually have a whole arm that just does cybersecurity, auditing, and risk assessments for pension plans. So they bring a different focus to the work, but as I said, I think both firms are acceptable choices. Nothing came up so far with the background calls that I've made regarding the two vendors. Did you have any comment?
My only comment was that I also thought that we wanted our executive director to make the choice because she's going to be working so closely with the implementation of our master plan. So I would be fine to go with Linear. It is less expensive. So that's kind of my input.
My past experience in public entities is that if both firms are qualified, you take whichever qualified firm has the lower quote. And so that's the mindset I bring to this. But I wanted to make sure the board knew that some of the distinction between these firms in case there was any significant feeling from the board one way or the other on this. And I'm sorry, Madam Chair, I think I cut you off.
That's okay. Catherine put her hand up, so I was just going to call on her.
Oh, okay, thank you. I'm just concerned about the evaluating of MCERA's reliance on county infrastructure and alternatives. Currently, our IT system is, I'm not sure what our current status is on our IT system, and if it is the interest of the board to develop alternatives. I mean, that's a very loaded sentence there. And I'm not sure if we need to have a discussion about that or, you know, what the pleasure of the board is on that.
Catherine, would you please repeat your assessment
Okay, I just,
again?
okay, client first, it's saying that their understanding of the county's IT environment may help evaluate MCERA's reliance on county infrastructure and alternatives. So what currently, are we totally tied into the county's IT, and do we want to look at alternatives and break away from that? That I needed some clarification on that.
May I address that?
Okay.
Thank you. Trustee Cavness, part of the strategic plan, as far as the objectives about technology, included specifically looking at MCERA's reliance on the county IT for infrastructure services and on county services in total. That was part of what was added to the strategic plan based on conversation at the offsite where we did the strategic planning session, and there was discussion about separation of relying on the county to perform certain services and what that would be. So that's why I included that. Function of the IT plan would be to look at that, to make a judgment call on, you know, for what we pay, are we getting a good deal? Are there better options that we should look at? And I think both firms could address that question, but certainly I think Client First has an intimate knowledge of the county's system because they did their IT plan and have been helping them implement a number of projects from the IT plan they did for the county. And I'll cede the floor to the next. And you'll steal it. I think Mr. Jurdy has had his hand up for a bit. Chair, I don't know if you can see him.
No, I see him, but I didn't see his hand. So Dan, yes.
Yeah, so just a little bit, I think Client First has done some good work for the county and the county IT department. I serve on an ad hoc committee for over a year now on the county's IT department. It seems like their biggest time requirements right now, besides sort of day-to-day issues, is working with new software, Aumentum, and another software that's working. It's finally updating about a 25-year-old software that the county's had for the property management system, and it's also has to do with the county's financial records. But at any rate, I think Client First did good work for the county, but I wouldn't say that that's a real driving reason to hire them for this purpose. I mean, if this other company specializes in pension systems, I think we should probably go with the other company, especially if they're a lower price.
Richard?
Yeah, Dan, I think hit the nail on the head. We're going to get the benefit of Client First right now because we're hooked into what they're doing. So if they want to, if they're telling the county to make changes or whatever, we'll get that. So I think these other folks probably would have the experience of looking at a separation or helping a pension system set up their own IT maintenance, I'll call it for lack of a term. So I have no problem with the lineal guys on this. I guess it's lineal.
Yeah.
Yeah.
Any other comments?
Trustee Anderson has his hand up, Chair. Again, you may not be able
Why
to see
am I
him.
not seeing hands up? Is that because I'm not in? Anyway, go
Maybe
ahead.
you should keep a participant list.
Well, I'm not. Are you raising your hands electronically, Jim?
Yes.
Okay, I'm not seeing those, and it might be because I came into this meeting in a different way than I should have. But anyway, I didn't. Those don't show up. So go ahead.
I was just going to share one other item with the trustees is that one of the things, at least to me, as part of the ad hoc committee that made Linea an attractive vendor was that they recognize that there's there's a risk of failure on IT projects is probably higher than most projects. And they understand MCER is a small organization, small staff, and they had built into their proposal ways to try to address all of the extra effort staff had to put on top of their regular workload. And there was a real, there seemed to be a real connection with the fact that MCER was unique given its size, and that their plan would give them the greatest opportunity for success given some of those kind of barriers that we know we have. We're in the middle of another major project, all of those types of things. They recognize those and address those in their proposal.
I'm kind of on the same thought pattern as Director Rentschler, and that if you have two qualified firms that you think can do the job, that you choose the lesser expensive one. So I'm with those of you who think that it's fine to go with the Linea Solutions. Is that a direction as a board that we want to give, Director Rentschler?
Yeah, Kathy, I would like to move that we hire Linea to help develop our IT master plan.
Well, we don't have a contract yet. So I think we, instead of making the motion to hire them, we move.
I think it's direction.
Yeah, direction for Doris to contract, or for Doris to work on a contract with them. Is that good, Jeff?
Perfect.
Okay, thanks. Okay, everybody in agreement? We won't take a vote on that. I'm gonna ignore your motion.
That's good.
That's
As long
fine.
as it moves it, that's.
Okay, all right. Well, let's move on then. I don't know if I asked, was there any public comment on our IT agenda item, Judy?
There is no public comment.
Okay. So the next item for discussion is discussion possible action regarding compensation earnable and pensionable compensation resolutions. And Director Rentschler wrote us a nice little memo about how we made a mistake last time.
So we did bring back the two compensation resolutions from last month because it was adopted via unanimous consent without anyone having actually made a motion or a second. So we brought this back for an administrative correction at Jeff's request to get a motion and formally adopt those two resolutions. Jeff, do we have to do roll call votes independently for each one of those resolutions?
Sounds like you're putting me on the spot with that, but I think you can do it. I think you can do one motion and one roll call vote.
Did you want to proceed with that before I go into the rest of the information about the two new resolutions? Or do you want to handle all the motions at the end, Chair Smith?
If we can handle all four of them at the same time, that would be wonderful.
Okay, so there are two additional compensation resolutions this month. The resolutions address new pay codes created by the County of Mendocino that they will use for exempt employees to make it easier for them to generate reports as far as pay to exempt employees. So in addition, I got an email late last night from the county's payroll office that indicated they have one more code they forgot to add to the list. So I wanted to know if the resolution could be adopted with a modification by the board to include the additional pay code of 604 for vacation cash out management exempt. Otherwise, all of the codes are mirroring pay codes that already exist, and there would be no new pensionable pay items associated with this. If it was a sick leave, now it's sick leave exempt. It's still treated the same as the other sick leave code. So there were a number of pay codes in the list, which was attached to to the memo, but you can see there was like a full page worth of pay codes that are essentially mirroring an existing pay code. And I would like to add one additional pay code to that list, being code 604, not on the list, but I would like the motion to include addition of that to resolutions 20 and 21, I think.
Yes.
So if I may, through the chair, so you're asking for a modification of what we have in our materials?
Correct. Can I do that on a resolution?
So I don't have that section of the Brown Act in front of me, but I think it would require a vote of the trustees that it was A, something that wasn't known at the time the agenda was published, and B, something of more of an emergency nature. So if there's some issue that there'll be pay codes between now and the next month that we meet, then you could make that argument. But if not, it probably technically should come back next month. And I'm sorry to be a fly in the ointment.
Well, I believe that payroll indicated that that pay code that they forgot to put on the list is going to be used with this pay period in question. Let's see. But I did tell them if it wasn't possible to add this, we would certainly just bring back another resolution next month, and we can make it probably retroactive to cover the pay period in question. So if that would be the better way to proceed, I'm happy if you would approve the resolutions as drafted, and I'll bring back additional resolutions next month.
And not on the consent calendar.
Not on the consent. I learned my lesson.
Yeah.
They will be implementing those. Yeah.
So without the additional code 604 that Director Rentschler has mentioned, I would entertain a motion to adopt the resolutions 17, 18, 20, and 21 that are listed on the agenda.
Madam Chair, so moved as presented.
Thank you, Quincy.
Second.
Thank you.
And I'm assuming there's no public comment.
There is no public comment.
Thank you, Jeff. Okay, if there's no further discussion, then let's have a roll call vote for the adoption of the 4 different pay code resolutions.
Ms. Cavanis?
Aye.
Mr. Journey?
Aye.
Ms. Smith?
Aye.
Mr. Cromer?
Aye.
Mr. Shoemaker?
Aye.
Ms. Harris?
Aye.
Approved.
Thank you. Moving on to agenda item number 10, budget update for the fiscal year, preliminary final report. Does that go to Robert? Okay, Robert.
Trustees, you have the preliminary quarterly budget update for the fourth quarter of 2022. I'd be happy to answer any questions that you may have.
I just want to say thank you, Robert, for the detailed explanations of all the increases and decreases in expenses. It makes it easy to read the report and know what's going on. So I appreciate that. Comments from any of the trustees or comments from the public?
There is no public comment.
So I guess, Robert, we will look forward to the final report, not the preliminary one. Okay.
Yeah, that should be, I think that'll be coming at the October meeting.
October, okay. Okay, thank you very, very much, Robert, for all the work you do. Move on then to the administrative report. Director Rentschler.
Thank you, Chair Smith. We have an election scheduled for later this year. The safety seat 7 filled by Trustee Cromer is term ends November 30th, so that election will begin. We will issue the notice of election tomorrow, I believe. Attached to your board materials was the timeline for the election. I believe that you'll notice that due to timing this time, with our new policy, we will be actually certifying or sending the certification of the election results to the board at the December meeting, which is the meeting in which the trustee would assume their term or continuation of the term if it's Mr. Cromer. So there might be a little bit of a timing difference this year, and that's all just due to the compressed timeframe that we had to operate in with the Board of Supervisors schedule and our November meeting being so early, et cetera. So that was something that's a little odd. Usually that occurs the month before the new term starts. I had intended to bring back the record retention policy with some updates based on the conversation with council. That's being postponed for a little bit because of the additional questions to be addressed as far as our electronic document management system and our retention policy. County facilities has indicated that they would not be able to continue to provide maintenance services for the building. So I have been searching for a maintenance contractor to take over the routine maintenance and repairs of the MSARA facility. I thought I had a contract out and was waiting to get a red line of the contract back, and I haven't heard anything back from the company, so I might just start searching again.
That include the HVAC system?
Yeah, it did. So I am looking for somebody who would handle all of the regular routine preventative maintenance plus any repairs that pop up for the building. And if we can get something in place, I'll bring that contract back to you.
Okay.
One item that I wanted to mention is that there are third-party bank account verification services. I mentioned that the Los Angeles County Retirement System has contracted with a firm to confirm that a payee's name and social security number are listed on a bank account used for direct deposit. That's to prevent it from being misdirected to an account that our retiree does not control. They also have additional services that LaSera uses to help identify potential instances of identity theft. They highly recommend these services, so I did look into it further and request a quote from 2 separate firms. Only one firm got back to me so far, and it's been like 3 weeks for the other firm. It would run, based on the one quote, about an ongoing cost of $9,500 a year. And MSARA currently is only processing about 200 new direct deposit setups per year, so that would make it rather expensive. And I just wanted to bring this information to the board in case the board had any desire to pursue that further. At this point, it doesn't really look cost effective given the low volume that MSARA processes. Okay. Moving on, I did add a couple of updates regarding our pension system. So MSARA has had an instance where a member passed. Our policy is that we pay for the full month in which the member dies. That typically goes through direct deposit at the end of that month. In certain instances, if the bank is aware of the member's passing, that bank account may be frozen or closed before we issue the payment, and that direct deposit payment rejects, at which point we've issued a check payable to the decedent and provided it to the beneficiary. In instances where a beneficiary has not been a spouse, that's been difficult for them to try to cash because the person's dead and they're not listed as the payee on the check. I did reach out to PG to find out what the cost would be to be able to set up PG to process the payment to the beneficiary. It would run approximately $5,800. for the change that would then allow us to use a beneficiary payee in all instances where the member dies for that final benefit payment. We process about 45 deaths a year. Again, we're deciding whether or not there's enough justification to incur the cost. I welcome any feedback from the trustees on that.
I have a question regarding that. Is that a one-time fee of $5,800 or is it a recurring?
That is
fee?
a one-time fee.
I mean, anyone that's been through a situation like that, I think anything that we can make easier for the beneficiary, the surviving members of that person from our system would be best. And I think it probably would potentially save staff time as well for not dealing with the direct deposit that's returned and then issuing the check. It's just delaying what should be done originally.
It might actually increase our staff cost as far as the processing time, because now instead of just letting that last payment go through direct deposit, we have to reach out to the beneficiary, get them to fill out some paperwork, get it back, put it in the system. But we would be consistent in handling everybody the same way, and it would resolve those few instances where the account is closed and the beneficiary can't deposit the check made out to the decedent. Or also it resolved concerns where the direct deposit went to an account that the beneficiary doesn't control, so they wouldn't have any claim against them, Sarah, at that point, because we would actually be issuing the payment to the named beneficiary.
So you did mention that you do process about 45 retiree deaths per year, but the number that where the bank account has been closed must be much lower than that.
Correct. I want to say that that's maybe one a year. It does not rise up very often. Most of the time that final payment goes through.
Well, and I understand, Quincy, what you're saying. I'm just not sure that the cost, is outweighs the benefit there.
I didn't realize it happened that rarely, but I still consider whatever we can do the best. But if it's only once a year, I think that that's not worth the price. I agree with your assessment.
Yeah.
Does
Yeah.
Judy or other staff have any input on it?
Doris has consulted with staff regarding the issue. We brought it to her attention, and I also questioned whether or not we want to permanently change our process going forward and spend that money to have PG customized.
I think it's something within the director and staff's realm to discuss and decide whether it's worth it to move forward. And even if you don't decide today, you might decide something differently in a week after you get 3 such instances or whatever. So I can certainly leave it up to you.
We at least know what the programming requirements would be at this point. And again, if it sits there for a bit and we come back to this in the future, we already know what to expect. So
Thank you for researching that.
I'll work with staff on that.
Okay.
I also have a couple of new items that we've requested from our software vendor for Pension Gold. We will be implementing 2-factor authentication to Member Direct, the self-serve portal for our members. This actually will be done essentially at no cost to us because 2-factor authentication is now available in their base product. And since we went through the process last year of upgrading the back end of the servers, et cetera, we can implement some of these new features that are part of the base product. So the addition of 2-factor authentication and the second item, the user statistics report, so we can know who's using Member Direct, how frequently, our penetration rate as far as getting members to enroll in it, that will be included again at no cost. The third item is a creation of the monthly retirement report. The monthly retirement report is part of the consent agenda every month. It is cobbled together from several different sources of information currently, which can be time consuming. But all of the information is in the pension system. It's just getting it out in a format that we can just easily present it to the board. So I did ask for the development of a report. I'm waiting on a cost estimate on that so we can get the information directly out of PG and not have to manually compile data from multiple sources in the future. Also, as Judy pointed out earlier this week, or last week, I guess it was, the monthly reports don't reflect changes with our court and district employers because the information they're using for active employment changes is a report coming solely from the county. So ultimately, when we get this change through, it would be more precise because it would include any changes that did come through for court or the district.
Great.
There's a legislative update for your review also, and I also wanted to mention that both Sonoma and Marin counties are submitting another letter of opposition to Assembly Bill 2493. We've discussed Bill 2493 in the past, and the board actually directed me to submit a letter of opposition to that, which was done. It's moved forward. It's had some additional amendments. Both Marin and Sonoma are objecting or lodging their opposition to that bill and have asked if Mendocino would like to be included in that letter and sign off on that, and it would come from the three systems. I reviewed what their concerns were, and I also have some of those same concerns, so I indicated that Sarah would be willing to sign off on the letter of opposition to Bill 2493. I'm happy to go into more detail if anybody needs it. And other than that, that wraps up the administrator's report unless you have any questions.
I'd like to make a comment, but Richard, go ahead.
So the curiosity about the maintenance contract for the building, was this an all-encompassing plumbing, AC, so forth on what I call minor maintenance, or was it a more in depth? They take care of major stuff.
The firm that I reached out to is a full service maintenance and construction company. They could handle probably even larger issues, but they would handle everything from replacing light bulbs because we don't own a ladder to plumbing repairs, minor electrical repairs, minor HVAC. But if it was a serious HVAC issue, they would call in an HVAC contractor. But it would be essentially comprehensive.
Okay, thank you.
I just wanted to point out, and board may have, trustees may have already assumed this, but part of our evaluation process, which we will talk about in closed session, asks for Doris to give more detail in her report about things that have happened during the month. So this is the first report that we've got that has a lot of detail, and I personally appreciate it. I do, I was able to read it all, so I don't know how much the trustees would like for her to explain or reiterate, but I do appreciate it being in writing. And I just wanted the trustees to realize that was at the board's request to do that. Any comments? And I can't see hands raised unless you actually physically raise them, but any comments or questions for Doris about her latest report? Catherine.
I just want to say thank you, and I certainly appreciate the greater detail.
Super. Let's then move on. Judy, any public comment about the administrative report?
There's no public comment.
Okay. Let's move on then to agenda item number 12, general board member discussion. Any trustees want to report on anything they have participated in that refers to or that is applicable to the board?
Kathy?
I don't see you, but I hear Jerry maybe.
Yeah, I just wanted to be sure that you continue the direction that was from us, I believe, that we want to have board education. I really appreciated having our talent group here, not only in person, but also the reports that they bring to us. I think it saves us having to go look for opportunities for board education amongst the ones that Judy sends us. But to have part of our board meeting take care of those requirements, personally, I appreciate it.
Thank you, Jerry. I appreciate it as well. Although then everybody knows who was in attendance at which session, and you expect me to remember all that stuff about private equity. I'll try. Okay, we do have closed session items today. The items have to do with a service disability application from Jeremy Mason. We have real property discussions for terms of lease renewal and terms of potential sale of the property on Kings Court. We do have a discussion about the public employee performance evaluation and our standing item with legal counsel about anticipated litigation referring to the HBRP. So I'm not sure what it takes, Judy, to move into closed session.
Madam Chair, if I may,
I don't see who. There's Quincy.
Quincy,
Yes.
with relation to the service-connected disability application, I will not be participating in any discussion or vote regarding that matter. I was personally present and involved in numerous aspects that are related to his claim, so I'll be stepping outside for that portion of the closed session and abstaining.
Okay, Quincy, thank you for letting us know that. So we will wait for Judy to tell us when it's
Call for
good to
public
go.
comment.
And just to confirm, there is no public
Closed session item 13, item A, the board voted 5-1 to grant the service-connected disability retirement application. Trustees Anderson, Shoemaker, Harris, Cavness, and Smith voted yes. Trustee Jurdy voted no, and trustee Cromer abstained. On items B and D, direction was given to staff and council. And on item C, the executive director received her performance evaluation.
Thank you, Jeff. So there being no further business on the agenda, we will adjourn today's meeting, and our next meeting will be on Wednesday, September 21st at 8:30 a.m. And I thank you all for sitting through a long meeting, and we will see you in a month.
Thank you.
Thank you.
Take care, everybody.
Thanks, Kathy.
Yeah.